Hey guys, welcome to the weekly video. Today we're going to do a video on straddles and strangles. Two strategies that have been working really well in this very volatile market. As we could see here, we've been having some big, huge moves down and up, down and up, down, and we don't know if it's going to go up or if it's going to go down from here. So what do we do in situations like this? Right, so we have a breakdown. If we break down this point here of support, we're gonna test the lows. Okay, it's first gonna hit here and then possibly gonna test the lows within the week or two. So we know where it's going, and if it pops back up and it comes up here and say it's coming to this point of resistance here where it's been hitting all this time, about here. So if it decides to, hey, it wants to keep on doing this motion of support here and resistance here, maybe I'll come back up here. So whatever it is, we're anticipating a big move, whether it's down or it's up. So what do we do in this situation? We don't really necessarily know direction per se, or we're neutral in the market. We don't really care if it goes up or down. We just want to make some money, right? So we go to our trade tab and we look for options. Okay, here we go. This is, let's go about 15 now. Yeah, let's go about 15 days out. So in our straddle, so when we straddle something, that means that we're just on it right in the middle. So a straddle, which is different from a strangle. So a straddle would be if I would just buy this 263, since the price currently of SPY is 263.50. That's what it closed at, but after hours it's 263.30. So the closest it would be this 263. And for one call, it's about $5.40, and for one put, it's about $5.25, $5.20. Okay, so it's fairly in the right where it's supposed to be. You want to be getting your straddles at pretty much the same exact price. So it would be better if this was 5 and this was 5, but this is pretty close. About 540 and 530. Okay, so when we say we want to buy a straddle, right? We go here, buy straddle. Okay, we're doing a let's see here. We're doing this 63 call and 63 put. It's only cost us $10.64 to buy this straddle. Okay, and here it is right here. This is $63 right here, $63.30 where it's at. Okay, in order for us to make money on the call side, it has to go past 270. Okay, and then we're going to be making some money. Okay, well, by expiration, it actually needs to go past. By expiration, it needs to go past 273 if we hold it that long. So here's your profit. Here's your profit and loss here. So this is, today, or yeah, this is today. The purple one is today. If your price goes to this point today, and then the blue is by expiration. So if by expiration of the straddle, and we don't want to hold to expiration because time decay, it kills options both ends. Remember, you're buying two options, so you're getting time decay on both sides of that option. So just keep that in mind. You do not want to hold a straddle to the end because the time decay is just going to kill you. Even if you go past 274, you know, if you go to 275, let's see, if we go to 275, you'll make $1,400. Okay, that's great, but it costs you $10,060 to buy, so you're only going to make $400, right? So that's not a good strategy. Okay, so on the put side, it has to go below. By the time it closes, it has to go. By the time it expires, it has to go below 252.30, and you'll barely make $30, right? Say it goes to 250, right? If it goes to 250, you'll make $2,000 or $2,300. But remember, you're paying $10,64, so $1,000 per contract straddle. So you're only going to make $1,300. Okay. But now if this moves quickly, and say this moves tomorrow, we go straight down to 252, right? If we go straight down to 252 tomorrow, then you're going to be up about $2,800. $2,800 to $2,700. That's a nice play if it goes in your favor that quickly. Okay. Now, if it, say, rallies and goes to 270 tomorrow, you're going to have, you know, a nice $1,400 profit, okay, on this straddle, considering that we have 15 days out. Okay. So basically a straddle is you're straddling the strike price right in the middle. Just like when you're riding a horse, you're straddling the horse. Okay, well, 263 is your strike price. You're straddling it, one call, one put, straight right in the middle. Okay, that's basically what a straddle is. You want to buy straddles on low volatility. Let's go back to our trade tab. So volatility is right here, implied volatility. And implied volatility for 15 days out is a 26% move, so 11-point move. So that's why if we go to 252 on Monday or tomorrow, then these are going to pay out nicely because we're going to have that expected move in a day. So we're going to get paid out. But if we wait till expiration and then we have the $10 move, we're not going to get any money because we're already priced in an $11 move. Okay? So that's a straddle when you're just basically one leg on the call side and one leg on the put side, and you want it to just go in either direction fast, right? So now let's look at a strangle. So for strangles, you're going a little bit out of the money on both ends. So imagine your hands around the neck of the option. You're strangling it. You have both hands around it, but there's a space in between because both of your hands don't fit around the whole neck, right? So I like to look for 0.30 or 0.40 deltas. So between 0.30 and 0.40 delta range. So a good one here would be for a call. I would say 15 days out, December 24th. I like $2. So a 70 strike call. And then this was 29 with a gamma of 3. So we take and consider gamma when we're looking at strangles, because gamma is the rate of change that delta will change for every dollar move. And for every dollar move the underlying stock price has, delta will increase the price of the option this amount. So every dollar move up, 29 cents will increase here. So this will go to, so 29 cents added here to 208 would be 237, right? Okay. So then, and after that adds there to 237, this is going to increase to 31. Okay. So this is going to increase that to 31. All right. So on our put side, look for deltas of 29. Okay, the closest we have is 28 and 30. All right, so what's the closest in price? So the closest in price is 257. So we look on our implied volatility. So here's implied volatility. This is our implied volatility for our calls. So for 270 calls, we have a 20% implied volatility. Okay, and for our put side, we have an implied volatility of 27%. So we have a 7% increase in volatility on the put side, which tells me that people are buying a lot more puts, so that the volume of puts are increasing, so the volatility of puts are increasing. So since the puts are in demand, the price of the puts are also increasing, because supply and demand. You want more of something? Well, we're gonna give it to you, but you're gonna have to pay a little bit more. Okay. So there's a lot more demand for puts than there are for calls. So the calls are going to be slightly cheaper. So because of this, we want to get the price as close as possible, but not affecting our deltas too much. So here we have a 29 delta for a price of, say, 205. All right, with the gamma of 3. So then we go and we say, all right, so the 255, we have a 0.28 with the gamma of 2. So my puts are going to increase slower than my calls. But my calls are cheaper, right, than my puts, because my puts are in high demand. So this one's 260, basically, 260. So I'm paying a premium of 55 cents in order to get this strangle to the put side. So it's not exactly neutral, but it's very, very close to neutral, as much as I could get. I would go with the 0.30, but that's 285. So that's about 80 cents higher than my calls. So if I'm neutral in this market, and I don't know if it's going to go up or down, and if I get, say, the 0.30 delta instead, and I pay a premium of 80 cents, which is $80 per contract, then if it goes in the call direction, then I have to exceed my price of doubling in order to break even, because I'm paying a premium of 80 cents. So here I'm paying a premium of 50 cents, 55 cents. So I would rather pay a smaller premium and be more neutral than to pay a higher premium and lean in one direction. Because if I'm just going to lean in one direction, I just might want to buy a vertical put spread, right? So I'm going to buy this 270 Strangle, 255. Okay. So 255. $255. Let's see here. Delete that. Okay. So here I have 270 call and a 255 put. I bought the 270 call for $2.05 and the 255 put for $2.55 for a total of $4.65. Okay, so now here it looks like, like the neck, and then here's one arm, here's another hand that's strangling this position. So now I need to increase. So if Monday comes up and I go to 252, if I go to 252 Monday, I'm going to make $2,900. I mean, not $2,900, about $2,700 if Monday goes to 252. Okay, Now, on the call side, if it goes to 270, let's see. So 270 is my call. So if it goes to 272, I'll be making about $19 to $2,000. Okay, remember it's saying the call side is going to be a little bit more. You're going to make a little bit more because the gamma and the delta were a little higher and the call was a little cheaper. Okay, less implied volatility. Okay, well, if I go to expiration, so this was 15 days out. If I go to expiration, I have to go past 274.60 in order to get some money on my call side. So about 275 I need to hit in order to make some money, and 274.60 just to break even if I wait to expiration. This is exactly why we don't hold these until expiration, because time decay just eats both ends, and you don't want to hold that. You want to hold for shorter times, not long times. Even if you have 15 days out, you want to hold for the maximum half that. Maximum half that. Okay, on our put side, we would have to go below 250. You know, we would have to hit 250 on expiration to basically break even. We would have to hit 250 to break even. Well, 250 and 33 cents to break even. With commissions and everything, that would break us even. Now we would have to go beyond 250 or hit 250 and below to actually make some profit on expiration. So the idea is we want a big move soon, within a couple days. If we're buying 15 days out, hopefully we get a big move within the next 3 or 4 days, 5 days max, right? So when we get those big moves soon, see, if we hit 250 tomorrow, for instance, on this Strangle, buying 10 and 10 contracts, we would make $3,800. That would be nice, right? If it went that far down that fast. You know, that's a 13-point move. Okay? Or if it went to 275 on Monday, you know, it would make $3,500. Okay? We want those moves fast. We want those moves in a couple days with these Strangles. Okay? We want to buy those Strangles with those same deltas and around the same price, because if we're buying at the same price, we have an even playing field, basically even. Now if we buy at a different price, say I bought a 260 put, right, which has a 40 delta and a 0.3 gamma with the implied volatility of 25%, which is $4. Okay, and I still buy the 70 call, right, for $2, 0.29 delta, 3, and a 20% implied volatility. I'm going to have a very different risk profile. So here, I'm going to buy the 260s, Strangle, $260 put Strangle with the 270 call. So remember, the 260 put Strangle, the 260 put was $4, and the 270 call was $2. So my debit total is going to be $6. But now let's see what happens here. Okay. So my risk tolerance on my put side is going to be a lot shorter. So if I go say Monday, let's just take this down to 1 to make it simpler. Okay. So if Monday comes and I go to say 255, if I go to 255, okay, the option total, right, cost me $600. So if we go to Monday, I'm going to be making $250. Okay, if we go to 255, all right, it's an 8-point move down. Okay. Now so that's 260, right? We're at 263, and we go to 255. 255 is an 8-point move. Okay. So 8-point move from 263 would be 271. Okay. If we happen to go to 271 on Monday, we'd be making $80 or so. Okay. Now, if the call side goes higher, say it goes to 275, okay, or 275. Let's go to 275. Where is it? 275. We'll be up, say, if it happened today, we would be up $267. Okay. Now that is a 12-point move. 12-point move, and we're only making $268. Now let's go a 12-point move on the other end. So 263 minus 12 points. Okay, that'd be 251. Okay, so 251. Sorry, got a phone call. So 263 to 251, we'll be making $500 or about $500 if it hit today, right? So $500 versus where was I at? 263 plus 12, 275. So about half, right? So you're not risking properly. You're favoring one side more, and if you go to the call side and it doesn't go as fast as you want, the premium on the put side is going to eat away and eat away. And I remember that was $400 per contract, and your call was only $200. So your call has to double in price in order to cover that, just to break even. It has to, no, not even. It has to double in price to cover the put side, but you'll still be negative $200 because you paid for the call side $200. Okay, so you have to get 150% on your call side in order to break even overall on your whole position, because you pay $200 for your 270 call, okay? And if it goes in the call direction, you're going to have to triple that call price that you paid. So you have to triple it in order to pay for the total $600 that it cost you, okay? But on the put side, because you went you went heavier on the put side and you bought a delta that was 40, and you paid $400 for it instead of $200 like the call. Now that doubles, and you pay for everything, and you're profitable. It doesn't even have to double. It could go up 50%, and you paid for everything. But the risk tolerance isn't equal, so you're not neutral. You're more heavy the put side than the call side. So that increases your risk. Because this is a neutral strategy. So buying a strangle or a straddle is a neutral strategy. So you don't want to be buying one that's 0.40 and one that's 0.29. You want to be buying the same deltas that you're anticipating around the same cost of the position. So you want to buy the same option deltas very close together, about 1 penny off, and you want to buy the closest to the cost that each one is. So this one's 205, say, and this one's 260. So 0.55 difference better than a 0.80 difference. And then this one here is a 0.35 difference, but your delta's 3 points away from this delta, and this one's only 1 point away. I would do this one better. Now, I mean, we could do that same thing with, say, a big stock like Amazon. Let's see. So Amazon, we have to go really out, right? So like 200 strikes, and we look here, and we look at our implied volatility right here, and we're already implying 121 point move for 12 days. So they're already pricing in 121 point move. So they already think a big move's coming. This week alone, they think a 91 point move is coming. So we're paying for that in the price. So right now, Amazon is at 16.29. Okay, and it looks like we have some support at 15.59 and resistance up here at 17. Okay, so if we're 12 days out and we don't know which way it's going, and we say 17 or 15.50, so our puts, you know, no, we don't even have any reasonable puts. If we're trading a smaller account, we don't have any reasonable puts in the 1,500 range. Okay, those are all going to be about $2,000. Okay, or yeah. So we come up here and we say, okay, well, let's see the deltas here. Deltas are really small. Okay, but Amazon moves really fast. So there could be a possibility where maybe we won't be in the money, but maybe some of these puts here, these puts where I could buy, if I wanted to risk it, if I wanted to buy, say, a 1,400 put, right, for 550, the delta of 7, okay, 1,400, right, I'm going to have to look on the other end for similar put at, what was that, 7 at 550. Well, say 580, 7. 580 and 7. Okay, about 580 and 9. Okay, about 580 and 9. So if I wanted to do a strangle, well, actually, I wouldn't be doing a strangle on Amazon. It would be too much. I would only be doing a straddle. No. I'm sorry, got that mixed up. I wouldn't be doing a straddle on Amazon. That would be too expensive. I would only be doing a strangle. Okay. So I would be doing 1825 strangle, 1825, and a 1,400 put. Let's see here. $1,400 put. Okay. So let's go down to 1 just to make it simple. So it's going to cost me a total of $1,140 just for one. Just for one. Okay, $1,140, $1,140. Okay. But now, so currently the price is right here. It's neutral right here. I believe so. Right. Let's see, what was the price again? $16.29. $16.29, basically. Okay, right in this area. Okay. Now, if Monday I get a big move, say down towards my 1550 area, right? If I get it going, if Monday breaks down and I'm at 1620 and it goes to 1550, then I would have a profit of about $3,000, about $3,200 if it goes to 1550. Goes to 1550, have a profit of $3,100. Okay, minus my whatever I originally paid, the $1,100. So I would have a profit of $2,000. Okay, that's a nice return. That's a double return if it goes my direction. If it goes to the 1550. Now, if Amazon shoots up tomorrow and goes to say 1,700, right? I'm not gonna have. Let's see, 17. So 1550. That is a 70-point move. A 70-point move this way. So my deltas, even though my deltas are pretty aligned, I was like 9 and 7. My puts were going to increase faster, and my calls aren't going to increase as fast. Let's see. Maybe the volatility. Let's double check. Implied volatility for the calls are at 44.45, and then for the puts, we're at 56. Nope. All right. Well, there it is. We have an increase if we go to 1550. Puts favored, right? Puts are, you see this slope right here? That is favoring the puts right here. The calls aren't being favored at all. Well, that's because I have 1400, which is, well, it's about the same. 200 from there would be 1600, and then 200 from 1600 would be 18. So they favor the puts on the which is weird because the volatility, the implied volatility, is higher than the puts. Here, implied volatility is 56 on the puts, and the call side, implied volatility is only 44%, which is very weird, but gotta go with what it says. Okay. So in order for us to make money on our put side, we have to move less than 100 points, and we're going to be making some really good money. In order to make some money on the call side, though, we're going to have to move a little bit more than 100 points. I mean, if we move 100 points, we'll make a little bit of money, but to cover our cost and some, we're going to have to go to about 1770, and that will give us 100% return on our strangle. Okay, so 1770, which would be a 150-point move tomorrow or 2 days combined, or we get 70-point move, right? Yeah, 70-point move to 1550, and we'll make 3,000 and make some good money. So let's see if this Strangle works out in the implied move tomorrow. Let's go back to the trade tab. Make sure I did that. 12 days out, 1400, 550. Implied volatility 56, and 1825. Implied volatility 45. Basically, yeah. Gamma 0. Okay. maybe that's the reason. Let's double check. So delta 9, gamma 0. Where we have here, nope, delta 7, gamma 0. Still same thing. Okay. Well, whatever changes that in the Analyze tab is what we have to go off of. But basically, let's go back to SPY and say, okay, a little bit of review. Straddle, we're going to be doing one strike, buy call and buy put. That's it. Buy call, buy put. Same strike. Strangle, we're going to go buy, call out the money, say 0.30 to 0.40, and then buy a put out the money, same deltas, and then same price that it cost. So if this one costs $3.50 at a delta of 40, then we'll be looking at possibly, let's see, let's go back. So 41 delta, 350. And I would be in between these two. Because that one's $3. No, I'm sorry. That one's $3.50. And so I would be in between these two and this one if I was buying. If I was buying, I'd be in between this one and these two for the 0.40s. Or I would jump on 0.39s for 320 and the 259s. So I would I'd get these two. .39, .37. I would probably be more inclined to get these two. You usually want to pick them right in between each other. So if we're at 263, we have 1, 2, 3, 4, 5, 6, 7 strikes up, and 1, 2, 3, 4, 5, 6, 7. So almost in the middle, one off. But I like the price points and I like the deltas a lot better. So I would be picking those for the Strangles. If I was doing this. All right, and again, Strangles. Straddles. You're just getting one strike and doing both. And then Strangles, you're going out. Same deltas, very, very similar cost. All right, well, I hope you guys enjoyed and learned something from this video. Please comment or post in the Facebook group your questions, and hopefully I could help you out. Thanks, guys.